In the same 24 hours in which Spurs recently played their first match at a new 62,000-seater stadium, the club quietly published its financial statements for the year ended 30th of June 2018 and announced world record pre-tax profits of £139 million. Now, this seems at odds with the tales of woe relating to the stadium completion, which involved delays due to steel cost overruns, labour shortages pushing up wage bills, and emergency loans that the club have recently taken out. So, have Spurs managed to be smarter than every other club in managing its finances, or have these financial results been subjected to the dark arts of accountancy? Well, the answer is a bit of both. Profit, simply put, is income less costs. Spurs' income grew by almost a quarter to £380 million in 2017-18. This was due to all three income streams, matchday, broadcasting and commercial, rising to record amounts. Matchday income is based on the number of matches played, the average attendance, and the average ticket price. Historically, Spurs have been constrained by White Hart Lane's 36,000 capacity. Fans have been resistant to increased ticket prices, and so the only way to boost income was via a cup run or qualification for the Champions or Europa League, as this increased the number of fixtures. With the move to Wembley for the 2017-18 season, whilst construction was completed, attendances increased to an average of over 68,000, and matchday income increased by over 56% as a consequence. Domestic broadcast income fell slightly as a third-placed finish was one below 2016-17, and the club earned less prize money as a result. But progress in the Champions League by qualifying for the knockout phase was an improvement on the previous season and more than made up for the domestic income decrease. The move to Wembley meant that the club was able to sell additional lucrative corporate hospitality packages, as well as sponsor income, and this boosted this revenue stream by an additional half to £109 million. Consequently, the revenue gap between Spurs and some of its perceived rivals narrowed. Arsenal's figures, for example, show the importance of qualifying for the Champions League, as they were the only club to show a decrease in income as a result of finishing 5th in 2016-17. Now, Spurs still have a lot of hard work ahead of them though, as Liverpool too benefited from impressive growth in 2017-18 on the back of an expanded Anfield and the prize money from progressing to the Champions League final. Chelsea's results also show the significance of Champions League matches, as well as that as a new kit manufacturing deal with Nike. In terms of costs, the major ones relate to players in the form of wages and trading or transfers. Spurs have been able to keep a tight lid on wages, as can be seen by the cost barely increasing between 2009 and 2016. Now, this was due to the benefits of academy products such as Harry Kane and Harry Winks, as well as recruiting from less glamorous clubs with the likes of Dele Alli from MK Dons, Danny Rose from Leeds and Kieran Trippier from Burnley. These players, while handsomely paid by the standards of most jobs, have been willing to accept salaries that are relatively modest by the standards of the rest of the Big Six, and have been willing to buy into the Spurs project under the present coach. Whilst Spurs a decade ago had a lower wage bill than the other clubs, they were also seen as not being contenders in the Premier League and only qualified for the Champions League once prior to 2016. Their wage bill last season was exactly half that of Manchester United, who only finished one place above them in the table, and at least £100 million below that of the other members of what the club sees as its peer group. How long this tight control on wages can continue is open to question, as the departure of Kyle Walker to Manchester City at the start of the 2017-18 season suggests that other clubs are admiring Spurs' best talent, and if the club fails to deliver trophies, heads may be turned to competitors with bigger wallets and trophy cabinets. In terms of player trading costs, Spurs' reluctance to compete in the upper echelons of the transfer market is well known, as demonstrated by making no signings to date in 2018-19. Since the start of the present decade, Spurs have had a net transfer spend on players of just £10 million per season. In 2017-18, Spurs were able to record a profit of £73 million, as Kyle Walker, Kevin Wimmer and Nabil Bentaleb all departed the club, as well as a cluster of fringe players. And they've been far more cautious than their rivals, who've spent aggressively but with mixed results. Big money acquisitions such as Angel Di Maria at Manchester United, Andy Carroll at Liverpool, Alvaro Morata at Chelsea, and Iliquian Mangala at Manchester City failed to justify their fees at the club. Spurs have tended to spend smart rather than big. Their net spend is less than a tenth of Manchester City's, and no more than a quarter of the sum spent by clubs that are supposedly its rivals. And this gap is going to grow even further when the figures for 2018-19 are taken into consideration. Those figures convey Spurs' strategy under Daniel Levy, and they don't take into account the cost of the stadium, and here, the accounting rules have benefited Spurs. In 2017-18, they spent nearly £500 million on construction projects, the majority of which has been in relation to the new stadium and training complex. However, none of this has impacted upon profits. Long-term assets, such as properties, are expensive, but are treated as assets in the balance sheet, not expenses in the profit and loss account. Their only cost is depreciation, which is charged over their expected period of use, but this only starts when the asset is first put into use. Because the new stadium was still a work in progress for Spurs during the 2017-18 season, there are no depreciation costs included in the accounts. Even the costs of architects, designers, lawyers and finance professionals employed by the club on the stadium project can be added to the materials and labour costs directly incurred in construction. These costs will therefore have no impact upon profits until matches commence, and even then, these are spread over the 50-year depreciation period according to Spurs accounts footnotes. If the stadium costs the quoted figure of £1.2 billion, then this works out as an annual expense of just £24 million. Now, Spurs have had to borrow money from banks to fund the stadium, and originally the main loan facility, which operates similarly to how a bank overdraft works in that Spurs didn't use all of it at once, was £400 million from HSBC, Goldman Sachs and Bank of America. Because of cost overruns, Spurs extended the loan facility to £537 million in December 2017, and then a further extension of £100 million in October of 2018. The interest costs in relation to the loan are, however, added to the cost of the stadium whilst it is being constructed and, again, have no impact upon profits until completion. So, where does this leave Mauricio Pochettino in terms of building a squad fit to compete for major trophies? Spurs are likely to be paying no more than 4% interest on the loans, which works out at an annual interest cost of about £25 million. The new stadium is designed for multiple purposes and will host other sports events such as NFL and major rugby union matches, as well as concerts. Now that should increase match day revenues from the 40 to 45 million that Spurs generated at the old White Hart Lane to at least the £110 million that Manchester United earn from Old Trafford. Whilst the new Spurs stadium has a lower capacity than Old Trafford, a combination of more modern facilities, greater emphasis on corporate customers, higher ticket prices, and a greater number of events taking place each season should more than make up the shortfall in capacity. The loans are scheduled for repayment in 2022, but the standard approach from banks is that they are usually willing to reschedule payment dates provided the borrower meets the regular interest payments, and on the basis of these figures, Spurs should not only be able to keep the bank manager happy, but their football manager should have a smile on his face too when he sees the playing budget.